Most people think they own cash flow rentals. They don't. They own properties that look like they cash flow on paper, in a spreadsheet, or in a social media post. But when you actually break down the numbers, most cash flow rentals are barely surviving, and some are slowly bleeding. Let's talk about why. First mistake, using rent minus mortgage as the definition of cash flow. If the rent is $2,000 and the mortgage is $1,600, most investors say, great, I'm cash flowing $400 a month. No, you're not. You're ignoring property taxes, you're ignoring insurance, you're ignoring maintenance, you're ignoring vacancy, you're ignoring CapEx, you're ignoring management, you're ignoring leasing costs, you're ignoring turns. That $400 disappears fast. Real cash flow is what's left after all expenses, not just the mortgage. Second mistake, underestimating maintenance and CapEx. Roofs don't care about your spreadsheet. HVAC systems don't care about your projections. Water heaters don't care about your optimism. Every property has a life cycle. If you're not setting aside reserves every single month for long-term replacements, you're not cash flowing, you're deferring reality. A property might cash flow for 2 years, then wipe out 3 years of profit in one major repair. That's not cash flow, that's volatility disguised as performance. Third mistake, ignoring vacancy and turnover. Even in strong markets, tenants move. When they do, you don't just lose rent. You might have 30 days vacant, cleaning, paint, minor repairs, leasing commission, utilities during vacancy. That one turnover can wipe out 6 months of your $200 a month cash flow. If you're not underwriting at least 5 to 8% vacancy annually, minimum, you're lying to yourself. Fourth mistake, buying for appreciation and calling it cash flow. A lot of investors say it only cash flows $100 now, but rents will go up. Maybe. But appreciation is speculation. Cash flow is math. If the deal only works when rents rise, taxes stay flat, insurance doesn't spike, and nothing breaks, that's not a strong deal. That's hope. Fifth mistake, ignoring financing structure. Interest rate matters, loan term matters, down payment matters. I've seen investors buy with minimal down, high rate, and tight margins, then call it a cash flow property because it's positive by $75 a month. That's not a margin, that's exposure. One insurance increase, one tax reassessment, one repair, and you're negative. Real cash flow requires margin. And here's the part most people don't talk about. Margin protects you from stress. When a property truly cash flows, truly, you don't panic when something breaks. You don't hesitate when a tenant leaves. You don't feel pressure when taxes rise because you built cushion into the deal. When I analyze rentals, I don't ask, is it positive? I ask, how wrong can I be and still survive? If rent drops 5%, am I still good? If expenses rise 10%, am I still good? If I have 2 months of vacancy, am I still good? If the answer is no, it's not a cash flow deal. It's a fragile deal. Most people are chasing door count. They want 5 properties, 10 properties, 20 properties. But 10 weak properties don't create freedom. They create management stress. One strong property with real margin beats 3 skinny deals every time. And here's the truth most gurus won't say. In today's market, true cash flow is harder to find. Prices are higher, insurance is higher, taxes are higher, interest rates are higher. If you're still underwriting deals like it's 2015, you're going to get crushed. You have to adjust your math to the market, not your hopes to the spreadsheet. So what does real cash flow look like? It looks like all expenses accounted for, realistic vacancy, maintenance reserves built in, CapEx reserves built in, management included, even if you self-manage, strong debt structure, and still a healthy monthly surplus, not $50, not $100, enough to absorb volatility. Because rentals aren't about the perfect month, they're about surviving the imperfect year. If you want financial freedom from rentals, you can't build it on thin margins. You build it on conservative underwriting. You build it on discipline. You build it on margin. And if your property only works in a best-case scenario, it doesn't cash flow. It survives until it doesn't. If this helped you rethink how you evaluate rental deals, hit subscribe. Because most investors don't fail from lack of opportunity, they fail from weak math.